Hello everyone. In this video we will learn about cafeteria benefit plans that are authorized by the section 125 of Internal Revenue Code. So let's get started. Let's first understand what a cafeteria plan is. A cafeteria plan is a specific type of a written benefit plan maintained by the employer for the benefit of the employees. So cafeteria plans are authorized by section 125 of the Internal Revenue Code that allows the employees to convert a taxable cash benefit, that is their salary, into non-taxable benefit. Under this plan, some employers offer their employees a choice between taxable cash pay or qualified non-taxable benefits. The employees can participate in this plan and authorize the employer to deduct certain withholdings from his pay on a pre-tax basis. These salary reductions are used to pay for the desired benefit and are taken out from the gross pay, and therefore they reduce the amount of pay that is subject to federal income tax. These salary reductions that are allowed under cafeteria plans are also exempt from FICA and FUTA taxes, and they are also exempt from state and local taxes. Let's talk about different types of cafeteria plans. There are POP, which is premium only plans. Then there are flexible spending accounts or flexible spending arrangements, and there are also simple cafeteria plans for employers with 100 or less employees. Let's talk about the POP plans first. This is the simplest type of the section 125 plan. Under the POP plans, the employees may elect to withhold a portion of their pre-tax salary to pay for the premium contributions for most employer-sponsored health and welfare benefit plans. And then the flexible spending arrangements are the reimbursement accounts that the employees fund based on those qualified expenses that they expect, like the dependent care or out-of-pocket unreimbursed medical expenses. How are cafeteria plans funded? Cafeteria plans are generally funded by either or both of the following mechanisms: flex dollars and or salary reduction. Under the flex dollar option, each employee is provided with a certain amount of flex dollars or flex credits which the employee can use to buy benefits offered under the plan menu or elect to receive in cash. So the employers make contribution for all plan eligible employees, and the employees use those contributions to buy various benefits. Employees can also make pre-tax contributions towards any benefit that the employer contributions do not fully cover. And the example that we can look at is the health insurance, towards which both the employer and the employee can contribute. The second mechanism is salary reduction. In this scenario, employees use part of their own salary to purchase their benefit selections through pre-tax or after-tax deductions. Purchasing qualified benefits through pre-tax deductions can provide employees with increased take-home pay. Salary reduction contributions to a cafeteria plan are considered to be employer contributions because the employees are electing to have a portion of their salary contributed to the plan by the employer. Let's understand with an example how it's beneficial to buy a qualified benefit under a cafeteria plan. I've used the example of medical expenses for health insurance. Let's say that the employer does not have a cafeteria plan. The employee is contributing towards health insurance that is not offered through the cafeteria plan. So his health insurance contribution deduction will be with the after-tax money. So if you look on the screen towards the left-hand side where it says post-tax method, which is without the cafeteria plan, see how and when the medical expenses are deducted. First, the employee's income is shown, which is $1,000. And then the taxes are taken out. he's taxed at 25% rate. So 250 came out and the adjusted income is 750, and the medical expenses are deducted after the taxes are calculated on the gross income, and his net take home pay for the week is $650. Now on the right hand side, the employee is offered health insurance through the cafeteria plan, and that's why he is allowed to contribute towards it with the pre-tax dollars. So if you look on the right hand side where the employee is offered health insurance through the cafeteria plan, the medical expenses are being deducted from the gross income before the taxes are deducted or calculated. So he has a gross income of $1,000, and the medical expenses come out, and the adjusted income is $900. From the $900, we will calculate the taxes of 25%, and the net take home pay is $675, which is more than with the post-tax method. So that's the main benefit of buying the benefits through the cafeteria plan, that the contributions can be made with the pre-tax dollars. Now let's see what is offered in the cafeteria plan. Not all type of benefits can be offered under the cafeteria plan. Following is the list of the benefits that can be included as a part of an overall cafeteria plan that is authorized by Section 125. So let's see at the examples. First one is coverage under accident and group health insurance plan, that is your medical, dental, vision, sick pay, other than the long-term care insurance plan. Coverage under dependent care assistant plans. Group term life insurance on lives of employee, even where the benefit exceeds $50,000, although the excess is subject to federal income tax and social security and Medicare taxes. Qualified adoption assistance. Premiums for COBRA continuation coverage. Accidental death and dismemberment insurance. Long-term and short-term disability. 401k, contributions to health saving accounts, and flexible spending arrangements. So this is the list of the benefits that can be offered under the cafeteria plan. It's also important to know what benefits cannot be offered through the cafeteria plan, and here is the list. Archer MSA, athletic facilities, de minimis fringe benefits, educational assistance, employee discounts, employer-provided cell phones, lodging on the business premises, meals, no additional cost services, retirement planning services, transportation benefits, tuition reduction, and working condition fringe benefits. That means that the employee cannot make pre-tax contributions towards any of these benefits. And if the employer is contributing towards these benefits for the benefit of the employee, then that may result in the taxable income to the employee. Now let's look at some of the requirements for the cafeteria plan. When the employer adopts a Section 125 cafeteria plan, it must be in writing, and it should indicate the description of the benefits available, requirement that the participants be employees. Now the term employees include any current or former employee, including any layoff or retired employees of the employer. It also includes the common law employees, leased employees, full-time life insurance salesperson, and a current employee or a former employee. But it does not include independent contractors. Other things that the plan should indicate is the procedures governing the employees' elections, including periods that elections may be made, periods to which elections are effective. The plan must provide that elections are irrevocable, except for optional change of status in the rules, which we will discuss later. The manner in which contributions may be made, for example, through salary reduction. To pay for the benefit, the employer contributions to cafeteria plan are usually made pursuant to salary reduction agreements between the employer and the employee. The employee agrees to contribute a portion of his or her salary on pre-tax basis to pay for the qualified benefits. Salary reduction contributions are not actually or constructively received by the participant. The plan should also indicate maximum amount of employer contributions available through the plan. It should indicate the plan year. And if there is no written plan, or if the plan fails to satisfy any of the above requirements, or if the plan fails to operate according to the written plan, then the plan is not considered a cafeteria plan, and the employee's election between taxable and non-taxable benefit result in gross income to the employees. Under the cafeteria plan, a key component centers around irrevocable elections. Here is the rule. Once an election is made, the employee may not change the election during the period of coverage, which is a 12-month period. But IRS recognizes certain events as an exception to this general irrevocability rule. These events fall into these groups: a change in employee's marital status, including marriage, divorce, legal separation, or annulment; an increase or decrease in the number of dependents, including the birth of the child, death of a dependent, adoption, and replacement for adoption; a change in the employment status of the employee, employee's spouse, or employee's dependents, including the termination or commencement of employment, a commencement of or return from the unpaid leave of absence, or a change in worksite; an employee's dependents satisfies or ceases to satisfy eligibility requirements for coverage due to the attainment of age, a change in student status, or any similar circumstance; a change in the place of residence of an employee, spouse, or dependent; a participating employee's reduction in work hours so that the employee is expected to average less than 30 hours of service per week; a participating employees becoming eligible for open or special enrollment in a plan offered through the health insurance coverage. So under these circumstances, the IRS allows the employee to revoke the plan. To qualify for a favorable tax treatment for all cafeteria plan participants, the plan must not discriminate in terms of eligibility, contributions, or benefits in favor of highly compensated individuals or participants or key employees. For benefit purposes, a highly compensated individual include corporate officers, shareholders owning more than 5% of the voting power or value of the employer's stock, and the highly compensated employee has a compensation of more than $130,000 for the year 2020 and 2021. And the key employees include corporate officers whose annual compensation is greater than $185,000 for 2020 and 2021. And they are 5% owners and 1% owners whose annual earnings are greater than $150,000. Let's again review the tax benefits of cafeteria plan. If the flexible benefit plan qualifies as 125 cafeteria plan, certain tax benefits are available to employees who participate in the plan. The employer contributions to the qualified cafeteria plan are excluded from employees' income, and they are not subject to federal income tax withholding or employment taxes to the extent the contribution relates to non-taxable benefits selected by the employee. Employer contributions made to purchase taxable benefits must be included in the employee's income and are subject to federal income tax withholding, Social Security, Medicare, FUTA taxes to the same extent as if they were made outside the plan. The pre-tax contributions, that is the salary reductions made by the employee to the qualified cafeteria plan, are excluded from employee's income. They are not subject to federal income tax, Social Security, Medicare, and future taxes. Whether the benefits purchased are taxable or non-taxable qualified benefits. Any taxable benefits purchased become taxable when they become currently available to the employee. Example, 401k distributions. Pre-tax contributions do not reduce the amount of the taxable benefit that must be included in employee's income. Pre-tax contributions made by an employee are considered to be employer contributions when determining the taxable value of the benefit. Let's understand the tax implication of certain benefits purchased under Cafeteria Plan. First one is health insurance. So the coverage under accident and group health insurance plan, medical, dental, vision, etc., other than the long-term care insurance plan is exempt from federal income tax, Social Security, Medicare, and future taxes. So it's not reported on box 135246 of the W-2. And the aggregate cost of employee and employer is reported on box 12 code DD. So the coverage costs include amounts both paid by the employer and employees in the pre-tax and after-tax money. Only employees who participate in the plan need to have this information on their W-2 form. The Dependent Care Flexible Spending Account let your employees set aside pre-tax money via payroll deduction to pay for child or adult dependent care expenses. If applicable, in box 10 of the W-2, state the dependent care amounts incurred by the employer for the employee and the amounts paid by the employee. Amount up to $5,000 is non-taxable and should not be included in box 1, 3, and 5. And the amount that goes over the threshold is taxable and should be included in box 1, 3, and 5 of employee's W-2. 401k. Generally, the cafeteria plan doesn't include any plan that offers a benefit that defers the pay. However, a cafeteria plan can include qualified 401k plan as a benefit. Contributions to 401k can be made on pre-tax basis. You don't have to pay income tax on the contributions, though you will have to pay payroll taxes, the Social Security and Medicare taxes. You don't pay the income tax on 401k until you withdraw the money. So the contributions are not reported on box 1 and 3 for federal income tax on W-2. They must be reported in box 3 and 4 for Social Security and box 5 and 6 for Medicare. The elective deferrals must also be reported in box 12, preceded by the code D on W-2. Now there are some contribution limits. If you are 50 years or older, you can make the annual contribution to 401k up to 26,000, which is the total of 19,500 plus the catch-up contribution of 6,500. While people under 50 can contribute up to 19,500. However, you can also make after-tax contributions to 401k and similar plans. Let's talk about group term life insurance. So you can generally exclude a cost of up to 50,000 of the group term life insurance coverage from the wages of the insured employee. You can exclude the same amount from the employee's wages when figuring Social Security and Medicare taxes. In addition, you don't have to withhold federal income tax or pay future tax on any group term life insurance you provide to an employee. The group term insurance over a 50,000 limit, you must include in your employee's wages the cost of the group term life insurance that is beyond 50,000, reduced by the amount the employee paid toward the insurance. That is reported as wages in box 1, 3, and 5 on the employee's W-2 form. And it is also shown in box 12 with code C. The amount is subject to Social Security and Medicare taxes, and you may or may not, at your own option, withhold federal income tax from the coverage above 50,000. Now, the HSA pre-tax contribution limit for 2021 for single coverage is $3,600 and for family coverage is $7,200. And there is also a 55 plus catch-up provision. So if you are 55 years or older, then you can for the self you can contribute up to $4,600, which is 3,600 plus 1,000, and for family coverage you can contribute pre-tax maximum of $8,200, which is 7,200 plus 1,000. Next is flexible spending arrangements. Many cafeteria plans offer another type of benefit known as the flexible spending arrangement, or FSA. FSAs give employees a chance to pay for certain covered health care, dependent care, and adoption expenses with pre-tax dollars. As the employees incur covered expenses, they are reimbursed up to the amount that will be contributed during the plan year through the salary reduction. Now, by using the pre-tax dollar to fund the FSA, the employee reduces his or her out-of-pocket expenses by the amount of the taxes that are saved. There is a contribution limit on the health flexible spending account, and the limit for 2021 is $2,750. Any cafeteria plan that doesn't limit health insurance contributions to the dollar limit isn't a cafeteria plan, and all benefits offered under that plan will be included in employees' gross income in that case. And here is a summary of the benefits offered under cafeteria plan and fringe benefits that are offered outside the cafeteria plan. I found this in publication 15B. I highly recommend that you review the IRS publication 15B for detailed information on cafeteria plans. That's all in this video, and I will be back with more videos. Until then, happy learning. Goodbye.